Now, all of this is made possible by what I consider the most dangerous and addictive hallucinogenic drug ever developed, and that is the illusion of ownership through the reality of debt. And that leads to the third suite of cards. And that's overdependence on debt and the private capital markets to finance housing. Because housing is costly to produce, and most producers are not extremely large businesses, most housing production is financed with borrowed money. More significantly, though, because housing is a commodity in our society, and it's long-lasting, the transfer of houses, existing housing, is financed almost entirely by borrowed money with property as collateral. That's what's meant by a mortgage. Furthermore, because housing is a speculative commodity, it's the prime source of collateral for borrowing even without transfer. That is, refinancing and home equity lending, in which people extract equity, not as they would take money out of a savings account, but by borrowing against it, using their home as collateral, with the expectation that they're going to have to repay. And finally, this is facilitated, and this is the transition to the fourth suite of cards, which is public policies that exacerbate the instability of the others. And these include monetary policy, fiscal policy, particularly the tax system, privatization of public institutions, and lax regulation and deregulation of private institutions. Let me say a bit about each of these. Monetary policy, loose money, particularly in the Greenspan era. Supposed guru has turned out to be a charlatan. The Wizard of Oz, the real guy behind the curtain, is not quite what the big image shows out front. Loose monetary policy encourages borrowing and speculation because it not only provides vast amounts of money, but because the interest rates are low, there's an incentive to borrow and then use it to speculate. Exactly. It's not simply income inequality directly, but the ability to take small amounts of actual capital and leverage it through very low-cost debt that's available in an era of loose monetary policy. And use that to invest in highly speculative ways that would yield much higher returns. Very attractive when you have lots of money sloshing around. Tax policy. Dick has mentioned the flattening of the progressive income tax, which widens income inequality and provides more money at the top for speculation, as he said. But I want to add to that the homeowner tax deductions for mortgage interest and property taxes. Sacred cows in our system, facilitating the American dream. Hardly. It's primarily a mansion deduction. It's a subsidy for big houses with big mortgages at high interest rates, and it's an incentive to speculation because it is highly regressive. The homeowner benefits flow almost entirely to people of high income because they're tied to how much mortgage you have, what your tax rate is, and whether you take the standard deduction or not. Highly strong disincentives to save, strong incentive to speculate in housing. Well, I'll talk a bit about the privatization and lax regulation, and in doing so, I'm going to have to be very brief because the time is getting short. But I will just mention to you, if you're interested in learning much more about the details of how this house of cards has been built, and in particular, the interface among these elements. I have two books. One is called Shelter Poverty, New Ideas on Housing Affordability, that came out in the early 90s, where I traced the long history of the buildup of this system until that point in time. And then a more recent book that I co-edited, Right to Housing, Foundation for a New Social Agenda, in which my chapter, Pernicious Problems of Housing Finance, which is available actually online, traces this process up to several years ago. And you can see how these elements have all fed together, and I really lay out the details of it. So I won't be able to go into to talk about those details. But one of the features, we all hear about the lack of regulation and deregulation. I want to talk more and just say briefly about the privatization of public institutions. When the economy in the late 20s spiraled into the Great Depression, the housing system was a very significant part of the speed and depth of the plunge because of a period very much like what we've been experiencing. In the late 20s, there was enormous speculation in real estate financed by what was then a rapidly growing mortgage system. With the 30s, a major part of the New Deal was the restructuring of the housing finance system. Not to eliminate mortgage lending and develop social ways of financing, but instead to prop up and facilitate that system. And one of the elements of that was what was called the creation of secondary mortgage markets. The Federal National Mortgage Association, which we know as Fannie Mae, was created in 1937 to try to provide liquidity, to make it possible for local lending institutions to be able to sell their mortgages to get money back to be able to re-lend it. The housing finance system that was created in the Depression was very significant in the post-war prosperity. For 20 years after World War II, our economy grew, home ownership expanded tremendously, at least for white middle-class people, not low-income people, not people of color for sure. Until the early to mid-60s, when the post-war prosperity began to crumble for a number of reasons we can't go into, inflation took hold, interest rates rose, competition for credit increased, and the housing system suffered disproportionately. As a result, there was a major effort in the late 60s into the 70s to expand this concept of secondary mortgage markets. Fannie Mae was privatized, a new Federal Home Loan Mortgage Corporation was created, known as Freddie Mac, and they were launched in a way to make it possible for a housing system to tap the broader capital markets rather than just depending upon middle-income savings. As we moved through that period into the 80s, this was coupled with deregulation of the financial system. There have been enormous pressures to do so. And with that, there was enormous transformations in which the primary sources of financing for housing ceased to be the accumulated savings of middle-income people, as it had been in the past, and instead became the global capital markets. One of the consequences of widening income inequality, amongst other things. With this, there began to develop what I call the Rococo system of housing finance. Curlicues upon curlicues upon curlicues, adorning a fundamentally unsound and unstable structure, adding weight but not strength to that structure. With this, the secondary market institutions began to create what are called mortgage-backed securities, where a group of individual mortgages get pooled together, and then shares get sold in that pool. The first generation of those are what I call plain vanilla securities. They were all exactly the same. Everybody who bought shares, these were pension funds, wealthy institutions, and in fact savings institutions themselves, always simply got a pro rata share of the payments for mortgage interest and principal each month. But sophisticated financial types said, hey, we've got a clever idea. We're going to issue securities against those securities. And what we're going to do is we're going to say, well, we're going to slice them up into what are called tranches. And the least risky ones will pay the lowest rate, and the most risky ones who get in line last will pay the highest rate, even though they're most risky. And then on top of that, that lowest tranche, or the most risky, people started issuing securities against those and selling them, offering increased opportunities for profit without recognizing the underlying increasing risk associated with this. As this elaborate process developed, vast amounts of capital flowed into the housing finance system. On the other hand, down at the bottom, home ownership was actually declining. So the opportunities to build this pyramid were becoming diminished. And so we saw, starting in the 90s with the Clinton administration, what had actually been a period of over 10 years of declining home ownership, the rapid promotion of home ownership, expansion of home ownership to people who hadn't had it before, especially households of color, but also encouragement of refinancing, of equity extraction from people from their existing homes, in order to make use of all of this money that the global capital markets was out there looking for opportunities for. And so mortgage standards were lowered, all kinds of mortgages were created. Subprimes are only one of a whole wild field of things, non-traditional loans, each posing enormous risks on the borrowers at the bottom, and ultimately the investors on the top. And so without being able to go into the details, this house of cards grew at a ferocious rate from the 90s up until the present. And that is what has collapsed, because at the bottom, three things have come together, this perfect storm.